Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC TV 18. The market has picked up a little bit, so we're around 20 points in the green right now. The banks also have moved into the green right now, so it's a 35-point gain that we are seeing on the Nifty Bank. And of course, the mid-cap index continues to outperform. It's almost 100 points higher over there, so that one looking quite strong. We'll talk more about the markets, but for now, let's get another corporate conversation going. HEG reported a weak set of third-quarter earnings. Utilization levels this time appear to be quite low, so we'll talk more about that. The margin has also come under pressure. Just to alert our viewers, the stock has been under pressure. You know, it's down around 9% in the last 1 month or so. The street was sensing a bit of a subdued quarter because of, commentary that came through earlier from other companies in this space. So to discuss, we're now joined by Manish Gulati, who's Executive Director at HEG, to take some questions. Mr. Gulati, thank you very much for joining us. I'm Pavitra. And, if we can just begin by talking about the utilization levels, because like I was mentioning, it does appear to be quite low. Can you take us through what the level is like for the quarter gone by for Q3?
Yeah, good morning. See, the capacity utilization for Q3 is in early 60s. And of course, as you rightly said, the volumes came under pressure, but that's because of the global event ongoing of this Russia-Ukraine war. The steel production year on year has been seen a 7% decline. But thankfully, we have been able to maintain or protect our margins, although the top line is down, as you rightly said.
Any pushback, sir, from orders? Last time you had highlighted the weakness in the European geography particularly. Are you getting any order cancellations or pushback or delays?
See, the pushback mainly happened after the Q1. It started to happen, then Q2 and Q3. And now it has, the demand has normalized. Some inventories, excess which they had, have been corrected. And whatever the real demand is coming globally is what is now shown up in our sales.
Okay, so then why is your revenue down 11%? If the demand has normalized, your revenues are down 11% year on year and on a quarter-on-quarter basis, sir.
Yeah, see, I'm expecting this Q4 volumes to be better than Q3. I think the Q3 volumes were the worst with all these corrections, and Q4 onwards, I'm expecting better volumes.
So you're expecting better volumes in Q4, Mr. Gulati. What are your current utilization rates? And I believe you also delayed your expansion plans by a couple of months. Can you give us some update on that? Just trying to get a sense of when you really think the business will bounce back and those utilization levels will pick up.
See, in this Q3, we are in early 60s. In the past quarter, Q2, we were in early 70s. And past Q1 was actually in early 90s. So gradually, our capacity utilization has come down, aligning our volumes with the demand. Going forward, Q4, I think that the volumes will be better than Q3. And we are looking forward for these global events to get corrected and maybe the normal demand to return maybe after another 2-3 quarters.
And okay, so what about the inventory position right now? How much inventory are you sitting on? Some sort of indications there?
Normally in our industry, we work with 1 month of working inventory, which is very, very normal. So it's now, let's say, close to 2 months. But that is really doesn't matter because we are awaiting the moment the demand comes back, we'll be able to liquidate it very fast. And in any case, we had a sufficient amount of our raw material inventories.
Okay, Mr. Gulati, just one quick question on the volumes once more. I think earlier you had indicated that would be for the full year it would be down around 5 to 10%. If you're saying Q4 is likely to pick up so much, is that still the level that you expect, or do you think it would be a little bit better than that?
No, as we total through the year, it'll still be down compared to the last year. The last year volumes were very good, and maybe a little more than 10% if we total for all the quarters. See, what I want to mention one thing here, that we are looking, when we don't look quarter by quarter as such. We are very upbeat and highly positive about our industry. See, there was a demand, I have been mentioning that a few times in these interactions, that there's about 20 million metric tons coming in US, there's about 16 million metric tons capacity switch happening from blast furnace to electric arc furnace. And we are happy to see that what we have been saying in past few quarters, one of the big industry players also said very recently that they are expecting the demand to go up by 200,000 tons. So we are very positive about our industry. The decarbonization which is happening is taking steam very fast. It is changing faster than we realize. It is just about this global event of Russia-Ukraine war getting out of the way, and the normal trajectory of electric arc furnace steel will resume, and thus will be the demand. And HEG has been the only company in the Western world expanding. And you mentioned about the expansion getting delayed. Yes, that's absolutely correct. We mentioned that in our results. There have been delays in arrivals of some of the equipments from mainly European suppliers, which is now on the way, and some of them have reached. So we are kind of running 3 months late, but really it doesn't affect as much, although we preferred we would have come on time, because the market is also at presently, we're not running at 100%. So the 3 months delay really doesn't impact us as much as it would have.
Okay, just getting back to that point about demand picking up, how much better would Q4 volumes be compared to Q3? Any rough indication? And what could your capacity utilization improve to from the current early 60s?
Yeah, I'm expecting the Q4 volumes to improve from early 60% level to 70%. That's I'm very sure of, because we're already in the middle of February. So I can see what is happening. So it should go back to 70% for Q4.
Okay, just a word on your expansion plans. Can you tell us how much capex you have lined up and whether there's a delay in timelines? Because Nigel was telling us that I think you have now shifted it to about April of this year, 23. The earlier deadline, the earlier timeline was December of 22. So are you still going to take this expansion in by April, or will you push it down a couple of months till the inventory position clears up and the market picks up?
No, we are nearing completion actually. So if there are 5 processes, 4 shops have already started. So it will definitely come in April. The total outlay has been 1,200 crores for this expansion, and we are very much sticking to that. So there's no delay because of anything, because more than half of the plant has already started actually. So just one odd process awaiting the start.
You did indicate there was a delay in arrival of some equipment from overseas suppliers, particularly Europe, because of which you had to push the completion of your expansion plan. But thank you very much, Mr. Gulati, for joining in. Q3 appears to be the worst for HEG. Things are improving. Q4 volumes to be better compared to Q3, and utilization will pick up. And the capacity expansion is on stream. It's on track, but it's just delayed by 3 months. Get into a break. We'll discuss technicals with Mitesh Thakkar.